The second tool that I'm going to show you to assist you with your cash flow is more of an overview. It's looking forward over the next 12 months and the viability of the business in general. The format should be very familiar to you because it's included in our performance reviews that we do with you every year based on your financial statements. You'll recognize how will the profit change, where will the money go, and the break-even point. First of all, how will the profit change? This is quite a simple calculation with just 5 steps. Looks complex, but once you've run through this a couple of times, you'll see how logical it is. The first step is to take last year's profit, or should I say the rolling 12 months profit up to the year to date, which for us, of course, is the end of February. And you take that figure straight from zero. So go into your reports, into profit and loss account there, and put in the correct dates, the date range, which of course for us is going to be from the 1st of March 2019 to the 29th of February 2020, and just generate that report. Okay, so you can see that our bottom line profit is 146,000. So our starting point, that's what we did up to the last 12 months. Step 2 is to complete the turnover forecast below. So what challenges does the turnover that we currently have of £774,000 face in the next 12 months? Well, at 2A, let's just pop in that turnover in the last 12 months. And then let's look at the challenges that we face. I've got some examples here. You will have your own reasoning as to how your turnover is going to change. So ABC Limited, I think we're going to lose £100,000 in trade with those guys. DEF, I think we're going to lose them as a customer completely. I'm going to make a general provision for bad debt in there of, say, £30,000. We've got a new product that I'm bringing out. It's going to have a modest impact, but I think it's going to bring in another £25,000. So I've now got my increase in turnover. Forgive me, in my case, it's a decrease in turnover, of course. And the next step for me to consider is what margin will I make on that? So what's the gross profit percentage? First of all, we'll look at last year's gross profit percentage. And remember, gross profit percentage is calculated simply gross profit divided by turnover. So in my case, 269,000 divided by 774,000. And in Blue Peter style, here's one I did earlier. I know that is going to be 35%. And then step 4 is to enter my predicted gross profit percentage for the next 12 months. Well, because of my new product, I think I'm probably going to do, say, 36.5%. Okay, so I've now calculated the impact of volume and margin changes on my profit relating to turnover. So I've got a reduction of turnover 125, and I've got an increase in GP. The increase in GP slightly relieves the losses that I'm experiencing because of my increase in turnover. Nonetheless, I predict that I'm going to lose £34,000 in bottom line profit because of my turnover and margin changes. So step 5, the last step in this example, is to complete the overhead forecast. So it's in a similar format to the turnover changes. Yep, so let's start out with last year's overheads. My example, I've got 122,000. Right, how are these going to change? Right, so I am going to get some business rate relief. So that's going to be a benefit to me, £5,000. Positive figures are benefits, negatives figures are costs, as above. I'm going to reduce my employee numbers, and that's going to give me £20,000, but I will have some redundancy costs of, say, £5,000. I have a bad debt from ABC company of £30,000, I think, and I'm going to pop £30,000 in there as a general provision as well. Okay, I've completed my how will the profit change. Just summarize that for you. In the last 12 months, I made 146 grand. But in the next 12 months, I think my turnover is going to go down by 125,000. And I think my margin is going to go up slightly. My GP percentage is 36.5% as opposed to 35%. So I will lose £34,000 from trading, and I'll lose £40,000 from overheads. My predicted profit for the next 12 months, therefore, is significantly reduced from £146,000 down to £71,985. Still a positive figure, though. So what impact will that have on my bank balance at the end of the year? Again, you'll remember this report from your performance reviews. We start off with the profit. So where will the money go? It starts with the profit we're predicting. And we now need to try and convert this profit into what will actually happen in cash. So let's make adjustments for non-cash costs. I know that I've got £20,000 in depreciation on my profit and loss account. I think my stock will stay the same. I think I'll collect an extra £100,000 from my customers because I am going to introduce some new procedures with the challenges that I face. I'm going to introduce some new apps to perhaps automatically chase my debts. I can speak to Ascentis about that. Hint for you there. But my suppliers are probably going to do the same, and so I'm probably going to face, say, £75,000 in additional payments to suppliers compared to normal. I am going to take advantage of the government loan scheme, and I think I'm going to borrow £50,000 from them. I'm going to get that government grant that's available of £5,000 as well. Last year's corporation tax bill is pretty hefty. It's £50,000. And I have to survive as well. And I need 65 grand out of the business to survive. So that means that out of my £71,000, after I've borrowed some money and got the grants, paid off last year's corporation tax bill and paid myself, I've still made a positive cash contribution to the balance sheet of £56,000. I had, say, £25,000 brought forward. That is my predicted bank balance at the end of the year. Obviously, play around with these figures, and you'll get a gut feeling as to whether your individual choices are correct when you look at this overall position. So the last document we've got here is completely automated. You don't have to do a thing. It's the break-even position. So it takes the estimated turnover for the year, the gross profit that you're anticipating to make for the next year, and it looks at the overheads and the amount that you're drawing out as directors and shareholders. It then takes these two costs, overheads and drawings, expresses it as percentage against the gross profit percentage, and that gives you the turnover that you need to break even. You need £621,000 in my example just to pay these two overheads off when expressed at 36.5%. So that's good news for me because of my break-even position, 621,000, is less than my estimated turnover. So in other words, I'm making £27,000 more than I actually need just to pay off the overheads. What we've done down here as well is we've put some tolerance levels in as well. You could see that if the GP decreased by, say, 5%, I would then fall short of my turnover by £71,000. And there's similar examples for overheads increasing and decreasing and gross profits changing as well. Hope it's very useful to you. Please call the office if you need any help with its completion.